Now, Raphael, I'm going to open this up a little bit. It's a long question, and I think there's several questions involved in this one for Raphael. And he says, I'm studying options from much time, and I like to sell put options. Okay, so we're talking about cash secured puts. Maybe you're doing some bull put credit spreads as well. All right, so naked put, we've got monthly picks of the day, weekly picks of the day, and the search tool. And he says, I know the volatility is one of the key points to finding a better opportunity for income. Well, it's a catch-22, Raphael. We're going to talk about that. As the higher the volatility, the higher the premium. Yes. Could you show how PO can help on this and how I can use it? Search the option for higher volatility, show the implicit historical volatility and how the skew graph can help and so on. Absolutely. Now, before I jump into that, I just want to say something here, Raphael. Catch-22. What I mean by a catch-22 is higher IV, like we've seen in April, because the market was more volatile. We started to see the higher IV, the VIX across the board, actually in March and in February. Saw some huge spikes in those time periods when we were talking about the tariffs and everything like that. I think the VIX jumped as high as, what was it, 59 during that intraday trading at one point. So what is volatility or implied volatility? It's a fear gauge of fear across the market. Things are uncertain. Things are unstable. Things can go wonky. Things can go wild. What does that do? That inflates the premium of our options, whether we're selling covered calls, cash secured naked puts. Maybe you're selling naked calls. Maybe you're selling straddles. Maybe you're selling strangles. Maybe you're selling iron condors into higher premium. But that's sort of a different catch there, right? Because if my short options are inflated on the same stock with the same expiration date, my long options are going to be inflated as well. I'm paying into implied volatility and increased prices as well as selling into them as well. But yeah, you'd see an increase in the bull put credit spread returns, iron condor returns in a higher volatile market. But what are all these strategies that we're talking about here? Naked put, just like the covered call we discussed a little moment ago, selling an out of the money put, great, give us some protection to break even, collecting a premium to increase that percent to break even. So maybe you're looking at a 6 to 7% to break even to make a potential 1.5 or 2% return if the stock stays above your put strike price and the put expires. In higher volatile markets, premiums increased. You might have a 9 to 10% to break even with maybe a 2.5 to 3% yield. Why is that a catch-22? This is all, aren't these numbers better than this? But these numbers are here because the market is fluctuating. Neutral strategy with a capped gain with a lot of downside, or a credit spread which gives you a good maybe double-digit return of 12 or 15%, but with a 5, 6, 7% drop on your stock, you could lose 100% of the maximum risk. I always like to say, you know, someone comes on and says, well, credit spreads are better, you have a low risk on the position. No, a credit spread is a known risk. It is only a low risk in your portfolio if you're a disciplined trader and you only allow the credit spread portion of your portfolio to be 10, 15% at max. Because if you're doing credit spreads with 50 to 60% of your portfolio and you were doing bull put spreads and you had that sudden move from the tariff announcements during the Powell years of 2022, 2023, every time he came out and made an announcement, the market shifted. You could be at 80 to 90% loss of the maximum loss in those positions. And if that's 40 or 50% of your portfolio, you're down 20, 25, 30%. Okay? So I want to describe the catch-22 first. You've got to be careful, Raphael, because the reason why the premiums are looking better is because the volatility was higher. As we saw, the VIX is coming back down to 23. But we're talking about neutral to directional strategies that carry a risk in one direction. If volatility is high, that's pointing us to the fact that there is more turbulence ahead and we could be ahead of rocky times. You're getting paid for that, but still have a large loss zone here. But absolutely. Let's talk about implied volatility and volatility across the market. Nice little feature that we have. We are going to get to the search, Raffaele. I'm going to show you exactly how to use the 2 or 3 criteria I would use for this search if I was looking for high volatility trades. Keep in mind, understand with the caveat that doing so is a catch-22 potentially because the positions that have a higher implied volatility are going to have the highest risk. Someone will come on and say, can you show me how to find the highest returning covered calls? And I say, yes, you won't like them. So I run the search for the highest return covered calls, highest return naked puts. What do you find? Biotech stocks, things with implied volatilities of 200 and 300% that have a phase 2 or phase 3 drug trial coming out within the next month or the next 2 weeks, which means the stock could pop up 20, 25%, or it could drop 80 to 90% if they fail that phase 2 or phase 3 trial. That's not a trade you want for a strategy that gives you a 3, 4, even 10% gain with a risk of losing 90 to 80%. So we have to keep that in mind. Let me go back to the homepage real quick. In our Learning Center, various things, guide on our courses, coaching, and where to schedule a coaching session, tip sheets that are available, tutorials, webinars. I want to go down here to market activity. And this gives us earnings announced this week, ex-dividends this week, stocks hitting new 52-week highs, including not optionable stocks. The market statistics page, excuse me, Raffaele, I want to go to optionable stock statistics. I'm sorry, folks. This page is going to give me a breakdown of most of the stock fundamental, stock technical, and broad overview option criteria across the entire universe of optionable stocks. Average stock price, 56.37. Max is 52.02. Min-max mean option bid price, that seems a little bit high, but that's what it is. Option last, that makes sense. Okay, but average peg ratio in the market, price to book in the market, so on and so forth. I'm going to go down here. The average 20-day volatility of all optionable stocks is 0.63. The 50-day volatility is 0.57. 250 days, 0.47. Makes sense. The longer you go out, the more that's flattened. The average implied volatility of all options, near-term expiration, far-term expiration, calls and puts, is 0.97. Okay, so that's pretty high, but that's essentially the average of all optionable stocks. As the VIX continues to drop, I'm going to expect this to drop down to maybe 0.85, 0.78, somewhere in that range. Now, what is this giving me? This is giving me a gauge of what is the average implied volatility across all options, of course, which relates directly to your question. Before I go into the search and say, I want to look for high implied volatility options. What is high implied volatility right now? A year ago, the average implied volatility might have been 0.65. In January and February, we were still running up with sort of the optimism that we were having. The average implied volatility might have been as low as 0.54, 0.50. Now, after the tumultuous end of February, March, and April that we've had, we're up to 0.97. So, higher the volatility, the higher the premium. Also, the higher the risk, Raffaele, inherent in the trade. But let's just take a look. We're going to go into naked put. We're going to go into search. Whether you want monthly, whether you want weekly, doesn't matter. What I'm going to do is give you some basics. We're going to clear the filters. We're going to empty everything out of the parameter filled from default searches. You can always go back, take a look at the weekly picks of the day, monthly picks of the day, tip sheet out of the money puts from one of our tip sheets. But okay, I'm going to keep 14 days out. That's usually what I like to do in my bull put credit spreads, Raffaele. I'm going to select all expirations. We could just go May. Let's just go May, 15 days away. Normally what I do is all expirations. And you know what? Let's do that. Let's do 6 to 16 days. So I'm going to see the weekly and the 2-week out naked puts. Implied volatility. Well, we knew that the average across the entire market, Raffaele, is 0.97. Your comment, higher the volatility, higher the premium. You're right. My statement, it's also higher the risk. 0.97 is the average. I only want to see options with an implied volatility of greater than 1.10 in this time frame. Percent implied volatility range. You had mentioned that search with higher volatility show the implicit historical volatility, how the skew graphic can help, okay? Well, we might look a little bit of that, but what I want to look at here is the percent implied volatility range. What is this showing me? This is showing me where the options imply, the actual option itself, where its current implied volatility is now compared to where it has been over the life of the option. So I want things that are at the higher range of their implied volatility range. I'm going to start off with greater than 80%. Only options that are 80% or higher of their implied volatility range since that has been released on the market. Excuse me, folks. Now, normally on a 1 week or 2 week out position, if I'm talking about something stable, Kraft Heinz, PG, McDonald's before their earnings this week, but they're still doing okay. Oh, sorry, folks, things along those lines. I'd expect maybe a 2 week out trade to have maybe a 0.7, 0.8% return on something stable. We're not talking about stable here at all. We're talking about higher risk, higher reward, playing the volatility to look for that higher return, knowing that we're taking on additional risk. Now, I'm not recommending this, but I'm showing you how to use the tools to do it. But a 1 week out or 2 week out, let's put this at 1.4. I'm looking for a high percent naked yield on the position. Earlier, when I was talking about the covered calls, I talked about the downside protection, how far the stock could fall before you start losing money on the position. In the naked put, we call it the percent to break even because it takes into account two factors: the option premium you receive and the range you are out of the money. So I'm going to want, taking some risk, taking some high volatile positions, I want a good break even here, but we're going 16 days out, so I'm going to put this as high as 7.5. If I was doing monthly, I'd put this almost at 10 or 12. But we're going 2 weeks out, so I'm going to try 7.5% to break even. Out of the money, yeah, we're going to look at out of the money. I'm not going to look at it selling in the money puts here. Probably going to want to be at least 4 or 5% out of the money. That's going to be easy to do, looking for this yield, looking for this percent to break even. And, you can increase that higher as well. Oh, by the way, I'm going to sort it by percent naked yield, highest to lowest. So we see those first. I do want some other basics. I'm not going to worry about delta. I'm not going to worry about bid-ask spread. You could limit the bid-ask spread. I'm not going to look for minimum option bid price. I'm focusing more on the higher return. If it's a $2 stock and it gives me a 4% yield, I'm fine with that. If it's a $100 stock, gives me a 4% yield, I'm fine with that. That's what I'm focusing on, not the minimum option bid price. But if your requirement was at least $1, you just plug that in. What? Not 1,000, Mike. Just $1. All right, you can limit the bid-ask spread, but don't, Raffaele, necessarily limit the bid-ask spread as one of your primary sorts for this particular search, because by definition, your options with the higher implied volatility are going to have a wider bid-ask spread. Use that as a secondary or tertiary sort of filter later on to narrow down your results, because they're all going to have wide bid-ask spreads. What am I going to want? I'm going to want some option volume today. I want to see some action. Let's put at least 10 contracts traded today and a good open interest, at least 100. From our previous brief discussion, just looking at that basic profit and loss chart, we're talking about neutral to bullish positions, aren't we? We're looking for higher returns now. We're looking for inflated implied volatility, absolutely. To meet Raffaele's terms, I should really take this up to probably 2%. I'm going to do that in a moment after we run the first search. But it's a neutral to bullish position. Yes, the market is now coming off of this low, but if I think the market is coming off this low and moving up, what am I not going to do? I'm not going to sell a naked put on a bearish ETF, which is declining in price now as the market's moving up. I want neutral to bullish positions. Let's put in some basic technicals. I want something that's, maybe the stock price is still above its 50-day or 100-day moving average. Based on the recent decline, I'm going to say at least 100, right? Because the last 50 days, we've seen some pullback. But I want to see a good uptrend. Maybe want to see something with a positive MACD, where the MACD is the MACD line is crossed over the signal line within the last 1 or 2 days. So I'm seeing a positive MACD turn. Of course, you could use RSI. We could put in other things for percent stock. You could use Bollinger Bands. I'm just putting in some basics here for the stock price and the change. If you wanted to limit your stock price to, Raffaele, cash secured naked puts, you're not looking for stocks more than $500. You could just put that in as well. See a positive stock change today. You want a minimum market cap. A lot of times the small caps are going to be the ones that match the higher implied volatility, to be honest with you. There's some good mid to large cap stocks out there. PE ratio, look for a good earnings per share growth, stocks that have grown maybe at least 5%, 7% in earnings, things of that nature. We're just going to put in those basics. And for now, I'm going to go ahead and submit the search. We're going to have a lot of results. We're going to go ahead and submit the search. Oh, only have 55. Okay, fantastic. So we've got HIMS, we've got Palantir, Carvana, 7-day out trades and 14 days at 5.2% yield. Where's my percent to break even? 9%, 15%, 18%. Now, TGTX Therapeutics, there's one. Carvana again, Palantir again, Carvana. And we've got different pages. Page 2, Avis, some more here. Dave, not seeing as many biotech stocks as I'd want. Transmedics, why not? Well, it's possibly because they didn't match that basic fundamentals, or they didn't match that basic technical. They're not above their 100-day moving average, and they haven't had the positive MACD crossover. I'm going to take those out, just as an example. We're going to take out the earnings per share growth. I take out those other technicals. They should all have the volume and open interest I looked for, because that was fairly basic, but we're going to take all this out. No upward stock trend, no positive MACD crossover, no positive earnings per share growth. We're going to get some more features in here with higher returns. Yeah, Upstart didn't match the first criteria because of one of those. AppLoving, Solar Edge, Sweet Green. Let's take this down one last time to one result per security. I'm leaving other strikes in there, but I'm going to tell you one down to one result per security. We have 27 results. Rocket Lab, IonQ, Astera, Trade Desk, him and hers, Groupon, Solar Edge, as I mentioned, AppLoving, Datadog, TGTX, there's the one, Celsius Holdings, so on and so forth. Transmedics. These are the ones that have the highest implied volatility range, sorted by the highest naked yield and the break even we wanted. You could open this up more by lowering the break even or lowering the range out of the money. You'd expect to see a lot more results potentially, Raffaele, here, and why are you not? And I'm going to say the reason why is because I'm still looking specifically for 80%. As I mentioned earlier, in the last 10 days, we've seen the VIX come down from about 36 down to about 22. Implied volatility is shrinking. These are the stocks that's still at 80%. If I put in 50%, we'd probably jump this up to 250 results, even still using the one result per security. Am I right? Let's take a look. Let's drop it down to 50. I said 250, right? Not 31, not as bad as I assumed. I apologize. So, but that's the case. I'm looking for 80 of the 80% range of implied volatility, so it's still at the peak. Lemonade, again, talked about some of those. Now, let's take a look. I'm guessing. I'm going to guess first. Let's take a look at the first one, Upstart Holdings here. Mid-range, hey, it did have our positive MACD crossover. Looks like about 15 days ago or so. And it crossed above the SMA 20. It's going good. It's a trend that I like to see. It's had the big decline from 90. It's lost, Jesus, I didn't realize it was that much. Sorry, folks. It went from 95 down to about 32. And now it's come back up to 50. That's a great move from 32 to 50, but that's a worse move there. So think about what? The structure of your trade. I'm not saying this is going to drop now from 50 down to 17, but highest implied volatility as the market started to increase. Do I want to be on a naked put on a stock that's doing this? Rolling down the put, rolling down the put. Okay, I'm coming back up here, rolling back up the put, still probably negative. Oh, got to roll down the put again, got to roll down and out the put again, got to roll down and out the put again because I'm losing money, still negative. Okay, now we're starting to come back up. I still want the stock to be in a trend that I want. And now we've done the search for you, Raffaele, that can find you those implied volatilities you want and the implied volatility range. We're looking for above the average as a minimum, the implied volatility across the market. Oh, sorry, folks. And at the same time, we're looking for those ones that are remaining that are still at 80 percentile of the implied volatility range. Is Upstart a good trade? Well, we just talked about the structure of the trade. Naked put in that situation. What is the one thing I can guarantee you? I'm going on a limb, just as I did before. I said it was going to be 250 results, and I was smacked in the face. I was completely wrong. But I'm going to go out on another limb here. I'm going to reduce these results by about 90% by clicking one button on the search. All right, we've got 27 total results. I'm saying I'm going to reduce this down by 90%. I'm expecting to see only 2 or 3 results with one click. Earnings date, not between now and expiration in the next 7 to 14 days. No stock combinations meet your search criteria. That's what I wanted to show you. All right. So you can find them. They're there. Why are they there? Because they're the ones with earnings coming up between now and expiration. The implied volatility is building up to those earning events for those 27 results that we saw. And again, even though with Upstart, we saw a directional position, we were out of the money, absolutely. We had a potential, what was it, 9.8% yield. We'll look at that back in a second. Well, I think it was as much as a 15% downside protection. Upstarts reports its earnings and it falls 25%. You're still down 10%. Or you buy the stock at 10%, try to repair it with a stock repair tool that we have on PowerOptions, or by selling covered calls against it. All right. I'm not saying, Raffaele comments, he says, yes, Michael, it's not the right time to sell puts. I'm not saying that necessarily. We're coming off of that low. We are seeing stocks enter in the positive. We're seeing SPX, SPY, I should say, QQQ, NASDAQ, and the Dow having that positive MACD crossover and showing that increase that we want to see. Okay, we're coming out of it. And we just crossed a point where we saw the market sentiment tool jump into the buy, the light buy, the strong buy, and then light buy sales again. So we're still in that bullish, I should say, market sentiment by the buy signals. What I'm saying is that the implied volatility, and you just saw it, that's the catch-22. You can use PowerOptions to find it, absolutely. You can look at implied volatility over historical volatility ratios as well as IV over SIV ratios. Just hover over to get the definition there. You typically just want to look for something that's greater than 1 for a quote-unquote overvalued option. So the Black-Scholes ratio, 50-day or SIV, you can use that too to look for overvalued options. Why are my options overvalued? If I have earnings between now and expiration, I'm taking a chance that the stock, even with that great protection we saw, that great percent to break even with these higher implied volatility positions that we saw, 15, it was a break even 14%, great, 14.7. Earnings are coming up in a few days, right? This one particularly, we're looking at the 14-day out trade. Yeah, Upstart doesn't have the 7 days out, so it must be after 7 days to expiration. Sorry, stock research tool, my apologies. Yeah, 5.6. Well, that's still within the range. I figured the 7-day would come out, just doesn't have enough premium. The one for the May 9th expiration, that's probably going to be most affected implied volatility crush with Upstart once the earnings come out. The earnings could be good, don't get me wrong, but you're taking that chance. The reason why we're seeing these inflated returns is because all of these positions have earnings coming up between now and their expiration date. That increases the fear, the unknown, a known event with an unknown outcome, Raffaele. And that's what you'll typically see when you run this search looking for the higher implied volatility, that higher kick. Benefits of the premium, absolutely. You see it on paper, it's right there. Why? Why are some of these implied volatilities double what the average is right now? I don't have that on my screen here. But why are these implied volatilities, why are these premiums double, triple, quadruple what some of their counterparts are with the same price ranges comparatively? Because they have earnings coming up between now and expiration, the known event in the future with our unknown outcome. That's the catch-22. That's what I wanted to enforce about the implied volatility. Can PowerOptions do it for you? Yes. Can it find you the best trades? If you're screening for implied volatility, high implied volatility, the more bang for your buck, the more juice for your drink, yes. Use that Learning Center tool. Find out what the average is. Pull your minimum implied volatility a little bit above that average. Look for positions with a higher percent implied volatility range. If you're buying options, you might want the reverse. I want something that's depressed and a low volatility that I think might jump, so I'd reverse this. I might look for an implied volatility less than 0.50 with the average of 0.97, and I want to buy an option that's currently at a percent implied volatility range, maybe below 35, maybe below 40%. I could do it that way. Catch-22. What might I see in that search result if we're looking for long calls or long puts with the lower implied volatility? I'm going to see something like Kraft Heinz. I'm going to see something like maybe Walmart, which might be a good buy for a call. Okay. I'm going to see something like McDonald's, Procter & Gamble, IBM. Things that don't move. There's no juice there. There's no real fear gauge in the market on those stocks because they just stable and move, stable and move, stable and move. Whether it's up or down, they're not losing or gaining too much. I want something with a little more kick for my calls. I want something maybe going into earnings that maybe has a low implied volatility. But guess what? If I'm 5 days, 10 days, 12 days to earnings, I'm not going to be at a low percent implied volatility range on those options. It's going to be near its higher range because the market is building up for that known event with the unknown outcome. But yeah, we've got the tools for you, Raffaele. Implied volatility screen, implied volatility ratios, comparing the implied volatility, the historical volatility of the stock, the percent implied volatility range, where the option's implied volatility is now compared to where it has been over the life of the option. That's all at your fingertips. You can, of course, customize the data columns any way you want to compare that. Just there's that second layer. Why does this option have the higher implied volatility? I'm looking at 2 stocks trading at $40. 5% out of the money naked put is offering a 1% return for a 14-day trade and an 8% return for a 14-day trade on the second $40 stock. 5% out of the money. Why such a drastic difference? Either it's got earnings coming up, it's a biotech with a phase 2 or phase 3 drug trial. You're taking that extra chance, directional trade, going through a known event with an unknown outcome.